Spotlight on the media space. The NCLT has sanctioned the scheme of merger between PVR and Inox, and we're expecting the written order to come out in the next few days. What exactly does this mean for the merged entity? Karan Taurani joins in, Senior VP, Elara Securities. Karan, thanks so much for taking time out. I just want to understand how this fuels the process for further approvals coming in for the merger and what potential valuation you're expecting now for the merged entity.
Right. I think this NCLT approval, was much awaited, and it's a breather, for the exhibition industry, which has gone through a lot of strain in the last 12 months in terms of, footfall loss. And I think in terms of timelines, I think, we could see the merged entity financials coming as early as Q1 FY24. What will happen now is that, Inox is getting merged with PVR. So Inox will, eventually get delisted. So there might be a blackout period sometime for about a couple of weeks wherein Inox is delisted and PVR is the merged entity. As far as valuations are concerned, I think the valuations remain the same. It's a share swap deal wherein somebody who has 3 shares of PVR, somebody who's got 10 shares of Inox rather, will get 3 shares of PVR. So it's a share swap deal, 3:10, and I think if you look at the overall valuations in terms of the combined entity, I think there is a potential, for the combined entity valuations to move up by 25 to 30% from current levels. So I think just to give you some perspective, I think the current market cap of both PVR, and Inox as on today is somewhere around 17,000 crores, and our valuation or our target valuation, for the combined entity market cap is somewhere closer to about 20 to 23,000 crores.
So, Karan, what's the outlook in terms of the merged entities, combined profitability and revenue potential?
Yeah, so I think the revenue potential, assuming all the synergies, what we have assumed right now is a revenue base of almost about 7,200 to 7,500 crores. And in terms of the EBITDA margin, rather, or in terms of base profitability, we have assumed an EBITDA margin of at least about 20 odd percent. So broadly, your absolute EBITDA number is coming somewhere closer to 1,500 crores, for F25 after factoring in the synergies and the combined entity put together. And as far as valuation multiples are concerned, so the cinema business in the pre-COVID times, a company like PVR, which was so large in terms of size and has always been the market leader, they were trading at a valuation of multiple of somewhere close to 14 times EV/EBITDA. Given both the companies coming together and the merged entity being so large and so much of synergies, right from revenue to a higher profitability, we believe there's a potential for re-rating in the valuation multiples as well. So we believe the valuation multiples, will probably move up in the range of 13 to 14 times to the range of 15 to 16 times. And if you multiply 1,500 crores roughly by 15 to 16 times kind of multiple, I think the combined entity valuation is somewhere close to 23,000 crores.
The deal is going to make money from day one?
So the EPS accretive broadly in terms of PVR, as I mentioned, that if you look at the market cap today of PVR and Inox merged both put together, the number is around 70,500 crores. And after putting in the synergies, after punching in the revenue numbers and the EBITDA margin estimates, your valuation going forward is somewhere close to about 23,000 crores. So broadly, the EPS or the earnings impact, or rather, if you look at the overall valuation impact, it is somewhere close to 35 odd percent, out of which 25% is because of the upgrade in terms of earnings and 10% is the revision in the multiples.
All right, Karan, thanks very much for putting all those details into perspective regarding PVR Inox.